Check those futures, please. The Dow is down 8, S&P up 4, Nasdaq down 40 points. Thomas Hayes joins me now. All right, it's earnings season. We've had, I don't know exactly how many of the S&P 500 companies have reported, but how are profits doing so far?
So far, so good, Stu. 12% of the S&P 500's reported. You had 8.5% earnings growth versus 8%. But we've been warning to watch out for the Magnificent Seven. And Warren Buffett once said, the three most important words in investing are margin of safety. And we feel right now at these prices with the Magnificent Seven, there is no margin of safety. They're priced for perfection at 30 times earnings with 14% earnings growth this quarter, down from 32% last year at this time. Also, you've got 32% weight in the S&P 500 for the Magnificent Seven, with only 23% of the earnings per share. And as we saw with Netflix last night, Stu, Magnificent Seven started with a thud. They missed on the bottom line, they slightly missed on the top line, and their guidance for margins was lower. That's what you want to be watching, is the guidance lower.
So you're raising the anxiety level here because the big tech reports next week, and you're saying the slightest fumble will take big techs down, and with it, the market goes down. That's really what you're saying, isn't it?
I am saying that. The S&P 500 has almost become a Magnificent Seven ETF.
Yep.
I think basically outside the Magnificent Seven, you could throw a dart and find a reasonably valued stock, but within the Magnificent Seven, they are priced for perfection. And so far, the guidance has not been magnificent. So, if you look at Netflix, if your number one show is called K-pop Demon Hunters, it may be time for your stock to take a rest, and that's what we're seeing this morning.
It did pretty well, I gotta say. All right, Tom Hayes, you've got us all worried now, but do come back soon, okay? We'll see you again. Thanks very much, Tom.
Thanks so much, Tim.
How about this? Barack Obama hitting the